What if you could claim a piece of New York real estate for less than the cost of a Broadway ticket? Sounds unreal, right? Yet that's exactly what a new wave of blockchain startups promises. Fractional ownership, instant rent payouts, and zero red tape. But here's the twist. The same technology built to democratize property might push it even further out of reach for the people who need it most. Back in 2018, a sleek condo project called 13th East and West tried to tokenize Manhattan. The pitch was dazzling. Developers Propeller and Fluidity would chop one apartment building into thousands of digital shares. Buy a token, own a fraction, watch the value climb. Reporters called it Wall Street for condos. Then the market blinked. Regular buyers asked, "Tokens, like video game coins?" Meanwhile, regulators squinted at the paperwork. Within months, financing stalled, the tokens froze, and the dream flatlined. The very first crash in blockchain real estate wasn't about price, it was about trust, and almost nobody noticed outside the crypto bubble. But that was just the prologue. Fast forward to now. A handful of platforms are rewriting the playbook. Lofty AI lets you scoop up a slice of a rental house for $50. Every night at midnight, an algorithm tallies rent, pushes stablecoins to your wallet, and drops a little cha-ching on your phone. One token, one vote. Investors decide if the roof gets fixed or the manager gets fired. Across the street, digitally speaking, Vesta Equity flips the model. Homeowners who spent decades paying off their mortgage can sell equity tokens instead of signing another loan. They pocket cash today, and investors gamble on future appreciation tomorrow. This year, newcomers are crowding in. Monoblock raised $40 million to break student housing into microshares. Reblock is turning entire REITs on-chain, so Wall Street can trade property the way gamers flip skins. Analysts say the tokenized pie could weigh in at $3 trillion by 2030, and Deloitte thinks mainstream status arrives by 2035. Suddenly, the condo coin flop looks like ancient history. Here's how the magic works. Package the property. A lawyer drops the deed into a brand new LLC. Mint the tokens. The LLC issues digital shares, each one stamped on a blockchain. Push play. Investors buy tokens, and the smart contract splits rent in real time. Trade in seconds. Want out? List the token on a secondary market and cash out faster than you can refinance a latte. On paper, it's frictionless. No banks, no notaries, no 3-inch stack of closing documents. Tokens travel at internet speed. Fees shrink to pennies. And because every vote happens on-chain, public, immutable, platforms claim they've cured the slumlord problem. After all, thousands of micro-owners should keep each other honest, right? Except, honesty is only half the battle. In May 2025, SEC Commissioner Mark Uyeda stood at a crypto roundtable and said the quiet part out loud. If your token represents equity in real estate, it sure looks like a security. Translation: file the paperwork or face the music. That same month, federal lawyers dragged startup Unicoin into court for pushing a property-backed token that allegedly mispriced Caribbean land by $600 million. The message landed like a sledgehammer. Tokenized bricks are still bricks in the eyes of the law. Platforms reacted in two ways. Plan A, shelter under Reg D. Sell only to accredited investors, millionaires who can stomach risk, and hope regulators warm up later. Plan B, build for Reg A+. Spend big on disclosures so everyday folks can buy tiny fractions legally someday. Meanwhile, legal blogs warn that every click, every rent payout, every emoji vote is potential evidence. One wrong turn and your digital duplex could vanish in an enforcement notice. Still, the money keeps flowing. On Zoom calls with early adopters, a strange pattern pops up. Many high-yield properties sit in lower-income zip codes. Small investors adore the fat rent ratios, but critics say that chasing cheap houses on-chain speeds up a trend already squeezing renters offline. Lawmakers smell smoke. The American Neighborhoods Protection Act wants big landlords to bankroll first-time buyers, The End Hedge Fund Control of American Homes Act aims to slap extra taxes on mega portfolios. Operators swear they're not hedge funds, just digital marketplaces, but the optics blur fast when an algorithm votes to evict for an extra 2% ROI. Tenants feel another layer of distance. If my faucet leaks, who do I call? The DAO. And when ownership is spread across 5,000 wallets worldwide, accountability can evaporate into a digital shrug. Yet for many homeowners, fractional equity tokens look like salvation. No monthly interest, no bank rejection letters, and the ability to buy back shares when life gets easier. Technology never lands in one piece. It lands in trade-offs. Zoom out, and the movement is racing beyond the US. In India, the fractional market just blasted past $500 million. A brand new SEBI framework forces platforms to publish audited statements, cap leverage, and list properties on a public dashboard. Rules that Wall Street wishes it wrote first. Gen Z investors, raised on crypto wallets and split pay apps, treat tokenized property like another line in a portfolio. A lofty survey finds their top 3 demands: mobile-first UX, environmental data, and the bragging rights of owning a beach house for $100. Luxury brands are testing co-ownership of villas in Bali. In Dubai, land department clerks now pilot NFT deeds. If geography once limited real estate dreams, a browser tab is busy smashing that border. BlackRock's digital assets team is reportedly sketching a micro-REIT that would let retirement funds drip dollars into single properties without touching Coinbase. Dubai's pilot could set off a domino effect. As soon as one government recognizes NFT deeds in court, every notary in the world faces an existential crisis. Then there's the whisper that Apple's Vision Pro 2 might showcase own-the-building holograms in AR house tours. Sounds crazy, until you remember people once laughed at online banking. But none of these headlines answers the one question that has haunted real estate since feudal times. In conclusion, will tokenization finally turn the American dream into a checkout cart reality? Or will it auction that dream, brick by digital brick, to the highest global bidder? Because when every square foot becomes a tradable chip, the line between homeowner and shareholder blurs fast. Maybe that's freedom. Maybe it's the ultimate commodification of shelter. The blockchain doesn't care. It just records the deal. So, next time you pass a for sale sign, ask yourself, is the buyer a neighbor or a DAO with 1,000 faces you'll never meet? Either way, the block is changing. And this time, it's literally on-chain.